Hello everyone, this is Victor here. At the time of filming this video, the Nasdaq index is in a large correction. The Nasdaq peaked in November 2021 and is down 17% from the most recent peak. The S&P 500 index is also in a large correction. The S&P 500 is down about 8.4% from the most recent peak. The S&P 500 is doing much better than the Nasdaq index because the S&P 500 is much more diversified in many industries. In comparison, the Nasdaq is much more tech-focused. If you're a growth investor like me and you have invested in many high-growth stocks or tech stocks in the past 2 years, you probably have many growth stocks that are down as much as 30% to 50% or even more from their most recent peaks. For example, I'm mainly a growth investor. My growth stock portfolio here was at 680,000 in November 2021 when the Nasdaq was near its peak. Now this growth stock portfolio is at 531,000. I actually started this portfolio with $5,000 about 12 years ago. Personally, I'm not worried about this large market correction because I have invested in some of the best companies that have increasing earnings and durable economic modes. I will talk more about this growth stock portfolio later on. In this video, I will explain why we're heading into a recession within the next 18 months. I will also explain whether it's time to buy the dip. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock reviews and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. Personally, I believe we're heading into a real recession over the next 18 months. I will give you several main reasons here. First, the US inflation rate is at a 40-year high. The latest data shows that the US CPI inflation rate is at 8.5% in March. This is the highest since 1981. The main causes are much higher energy prices caused by the Ukraine war, higher food prices, higher shelter costs, higher wages, and the global supply chain issues that are still ongoing. The US Fed much prefer personal consumption expenditures. PCE inflation rate is at 6.4%. This is much higher than the US Fed's average 2% target inflation rate. The US inflation rate is way too high now. The US Fed has two mandates: maximizing employment and achieving stable prices in the US. At the time of making this video, the US Fed has already achieved the first goal of maximizing employment in the US. The US unemployment rate is 3.6% in March of 2022. This is the lowest unemployment rate since February 2020 before the pandemic started. But the biggest problem is this: the US inflation rate is way too high now. To avoid the risk of hyperinflation similar to the late 1970s, which in my opinion is the worst case scenario, the US Fed has no choice but to raise its interest rate, known as the Fed funds rate, aggressively going forward. In addition to raising interest rates, the US Fed will start its quantitative tightening most likely in May. Quantitative tightening is the opposite of quantitative easing. Quantitative tightening means the US Fed will start decreasing its $9 trillion balance sheet, which is made out of US treasuries and mortgage-backed securities. The US Fed will let these bonds mature instead of reinvesting them in more bonds and government debt securities. This quantitative tightening will decrease the amount of money supply in the economy and decrease the amount of money banks have to lend to consumers and businesses. This means we can expect borrowing costs for both consumers and businesses will continue to increase significantly going forward. This is why you can see mortgage rates in the US and Canada have raised significantly in recent months. For example, in the US, the 30-year fixed-rate mortgage has already reached 5% for the first time since 2011. When interest rates and borrowing costs are rising quickly, growth stocks that have negative earnings and negative operating cash flows are always affected the most because these money-losing businesses often rely on debts to finance the growth. ARK ETFs have underperformed significantly since the beginning of 2021 because we no longer have easy money monetary policies. The former US Treasury Secretary Larry Summers said this in a recent Bloomberg interview. He explained that the US economy will likely have a hard landing. He said, "I think it's the most likely thing. If you look at history, there has never been a moment when inflation was above 4% and unemployment was below 5% when we did not have a recession within the next 2 years. So I think the odds on a hard landing within the next 2 years are certainly better than half, and quite possibly 2/3 or more. I don't think the idea that is still embodied in Fed forecasts that we could have continued super tight labor markets at 3.5% unemployment and we could have inflation come down rapidly is terribly plausible one. That's a residue of team transitory. And the key fact one has to recognize, I think, to grasp the current situation is that wage inflation is now running above 6% on the best data, which is the Atlanta Fed indicator. And if wage inflation is running at 6%, that's a kind of ultimate core inflation pointing to price inflation at 4.5% or 5%. So I think we're either going to live with that for quite a while, in which case we'll have an even bigger recession later, or some set of events involving monetary policies and involving what happens in the real economy are going to force a hard landing. I'm much more agnostic on how high interest rates are going to have to go to generate a hard landing and disinflation that I am on the likelihood that at the end of the day, we're going to see a fairly hard landing. There are other reasons that will likely cause the US economy into a real recession over the next 18 months. Hopefully, the US economy will have a soft landing instead of a hard landing. The current Ukraine war is causing energy prices such as crude oil and natural gas prices to increase significantly in the past 2 months. The Ukraine war has caused food prices, especially wheat, corn, and sunflower oil prices, to increase a lot in the past 2 months. The global supply chain issues and chip shortage are still ongoing. Recently, Shanghai started the largest COVID-19 lockdown since the pandemic that started in 2020. Shanghai is the largest economic and manufacturing center in China. Most factories in Shanghai are either shut down or are operating at a much reduced capacity because of the COVID-19 lockdown. This means the COVID-19 lockdown in China is causing more supply chain issues and bottlenecks around the world. Many Western companies such as Apple, Tesla, and Volkswagen rely on China's manufacturing plants to make their products. Finally, we have the inverted yield curve. Typically, short-term interest rates should be lower than long-term interest rates because short-term debts should carry lesser risks than long-term debts. This means the yield curve should slope upward in a normal market condition. This is called a normal yield curve. However, when the short-term US Treasury yield is higher than the long-term yield, the normal yield curve becomes an inverted yield curve. An inverted yield curve is not normal because longer-term debts should carry greater risk and therefore higher interest rates. For example, in recent weeks, we had several days of inverted yield curve. The US 2-year Treasury yield was higher than the US 10-year Treasury yield. Again, this is not normal. The inverted yield curve is one of the best indicators of recessions. Historically, the inverted yield curve has predicted all the recessions since the 1950s. Now, here is the important part. Having an inverted yield curve does not mean the US economy will head into a recession right away. Historically, since 1955, the US economy went into recessions within 7 to 24 months after the yield curve inverted. Here's the important question you may ask. Is it time to buy the dip or should we wait? Here is my honest answer and opinion. No one can predict the market. I don't think anyone can predict what the market will do the next day, the next week, the next month, or the next year. I don't think anyone can predict the market bottom. As a long-term investor, I believe the best thing we can do is to take advantage of the market when the market is very pessimistic and fearful. This means keep buying more stocks of outstanding businesses gradually instead of trying to time the market and trying to predict the market bottom. Since no one can predict the market, I believe it's important to buy stocks of outstanding businesses gradually, especially when we're in a large correction. For example, I always use this fear and greed index here to see whether the market is fearful, neutral, or greedy now. At the time of making this video, the market is fearful. This means many US stocks are undervalued. Just a month ago, the market was extremely fearful. This means many US stocks were greatly undervalued when the Ukraine war started. The best time to buy stocks is when the market is very fearful because most US stocks will be traded below their intrinsic values. And of course, the best time to sell stocks is when the market is very greedy because most US stocks will be traded way above their intrinsic values. In my opinion, no one can predict the market bottom. I believe a good strategy is to keep buying shares of the best companies gradually and investing in them for the long term to reduce risk. This means keep buying the dip gradually and not all at once. My strategy is to invest in the best companies that have increasing earnings and durable economic modes, then invest in them with a good margin of safety. I will give you several examples here. At the time of making this video, I'm managing about 1.1 million of investment assets between my portfolios and my fiance's portfolios. I'll show you my main gold stock portfolio here as an example. If you look at the portfolio here, you can see my biggest gains came from Apple, Amazon, Alphabet, MasterCard, Empire, Mercado Libre, Microsoft, Nvidia, Tesla, and Visa. These gains are mainly capital gains and not from dividends. I'm actually very fortunate because my capital gains from the winning stocks more than offset my temporary losses from the losing stocks. Many YouTubers don't show their portfolio's realized gains and losses, but I believe it's important to be transparent. These are my realized gains and losses in the past 2 years. I can only go back to a maximum of 2 years here. In the past 2 years, I sold many stocks. If we add all the realized gains and the realized losses, the total net realized gain is $47,886. After selling these stocks and making gains on them, I reinvested the capital gains in other stocks to grow my portfolio further. In the past 2 years, I made a large mistake of investing too much into growth stocks. I did not expect the US Fed's interest rate hikes and monetary policy tightening would have a huge impact on growth stocks valuations. Now I know. For example, I made a large mistake of investing too much into Coinbase, Coupang, Netflix, Roblox, C Limited, Shopify, and Block. You can see all these growth stocks are down a lot because the US inflation rate is too high and because the US Fed has started raising its interest rates aggressively to fight inflation. In my opinion, many of these companies are still great businesses, but many of them do not have consistent strong cash flows yet, or they are still losing a lot of money every quarter. This is why they are impacted the most when the US Fed is tightening its policies and raising its interest rates aggressively. If I can start this portfolio over again, I will focus on investing in the best companies that have strong free cash flow growth, strong fundamentals, large economic moats, and increasing earnings over time, instead of investing too much into growth stocks that do not have strong free cash flows yet. For example, if I am starting a new portfolio again, I will focus on investing in Apple, Google, Microsoft, Amazon, Tesla, Nvidia, and Costco. In my opinion, these are some of the best companies with durable economic moats and increasing earnings. For example, they can often pass higher inflation costs to their customers, and their customers will still buy their products and services. These companies also have strong free cash flows. I always say this, cash flow is the king in recessions. Another important lesson is this, when we're investing in stocks, price is what you pay and value is what you get. In this market, I believe it's important to always invest with a good margin of safety instead of overpaying stocks. Investing with a good margin of safety means buying the stock when it is traded below its intrinsic value. Investing with a good margin of safety will help you reduce the risk of overpaying a stock. The general rule of thumb is this, a company with more risk should be bought with a larger margin of safety. For example, Costco has very low risk, so I would not mind buying the stock when it is fairly valued. Meta has a lot of risk. Meta is competing with TikTok to attract new and younger users. Meta is also competing with Google in online advertising revenues. Personally, I would want Meta to have a 30% margin of safety before buying more Meta shares. I always use this intrinsic value calculator to calculate each stock's intrinsic value, so I will know whether the stock is undervalued, fairly valued, or overvalued. If you want the latest intrinsic value update, you can download it in my Patreon blog in the video description. For example, using this intrinsic value calculator here, I estimated Costco's intrinsic value to be around $510 per share. I bought a very small position in Costco 3 months ago when Costco stock dropped to very close to my intrinsic value. I bought Costco shares because I know Costco is arguably the best and most competitive membership-based warehouse club in the US. Costco's business is also inflation-proof. At the time of making this video, my Costco position is up 14.68%. If Costco drops to my intrinsic value estimate again, I will buy more Costco shares for the long term. To summarize, I want to share with you this excellent investing insight from Warren Buffett. Warren Buffett wrote this in his 2017 shareholder letter. Charlie and I view the marketable common stocks that Berkshire owns as interests in businesses, not as ticker symbols to be bought or sold based on their chart patterns, the target prices of analysts, or the opinions of media pundits. Instead, we simply believe that if the businesses of the investee are successful, as we believe most will be, our investments will be successful as well. Sometimes the payoffs to us will be modest. Occasionally, the cash register will ring loudly, and sometimes I will make expensive mistakes. Overall and over time, we should get decent results. In America, equity investors have the wind at their back. Buffett also wrote this in his 2020 shareholder letter. He said, "Our unwavering conclusion, never bet against America. In my opinion, the US economy will very likely head to a real recession within the next 18 months. Hopefully it will be a soft landing and not a hard landing. My plan is to continue buying shares of the best companies gradually and buying them when they are undervalued with a good margin of safety. The market will eventually recover and reach new highs again. Just like Warren Buffett, I will never bet against America. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting my channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.